Welcome back, viewers, to another episode of Questions with Matt and Mark. This week, it's going to be Questions with Matt and Nick. Welcome, my friend.
Thank you. Good to be here.
For viewers that don't know, Nick is our Director of Research and Trading. Guy's an absolute rock star, so you're blessed to have him on this week. Nick, I'll go first with the question. So we hear more and more about something, the old Wall Street adage of sell in May and go away. And with September now hitting the calendar, with that old Wall Street strategy, people tend to buy back. So why don't you explain to viewers, 1-2 minutes, what is that adage and what kind of surrounds it?
Absolutely. So the old adage of sell in May and go away, it really has to do with seasonality in the markets. And so when you think about the calendar year, January obviously all the way down to December, the beginning of the months, you're going to have more contributions to retirement, so more money kind of flowing into the month in that first quarter, second quarter. When you get into the summer, May, June, July, things start to slow down a little bit, and particularly on the volume front. So if you're watching the markets, your volume is going to kind of go down, and a lot of it has to do with the seasonality of life. A lot of people are on vacation, and so there's a bit more, I don't want to say a pause, but it's a bit more of a choppy market typically in the markets in that summer period. And so sell in May and go away, coming back into September. Once September comes around and you're really starting to pick up towards the end of the year and head into Q4, you'll see you'll see volumes pick up, so you'll see a lot more activity in the markets, and you'll start to see, again, going back with the whole adage, you'll start to see people chasing the winners, as they're trying to meet their targets and their goals towards the end of the year. So year end at the same time, you'll see investors chasing the winners, and you'll see what another term is called window dressing.
Ooh, you guys get a special. You get 2 questions for Nick this week. Answer that one.
So window dressing, you'll hear it in terms on an annual basis and also on a quarterly basis. It's basically when a hedge fund manager or a fund manager will sell the losers and buy the winners towards the end of the quarter. And a lot of times this actually happens like on the last day of the quarter as they kind of reposition their portfolio, and that's why they call it window dressing.
Because they make it appear that they were smart during that quarter or year and they owned those winners,
right,
when in actuality, Nick, they may have bought them that last day.
Right, exactly. And it's just a way, when you show hedge funds will show their clients, oh, this is what we're owning at the end of the quarter, or whenever big public companies have to file for their end of quarter holdings, it will look different than maybe what they held. So there's a lot of things going on behind window dressing. It can be that some of these big names are trying to hide what they were in earlier in the quarter. It can be hedge funds trying to show that they were actually performing better than they were. A lot of things go on, but you'll have window dressing towards the end of the year, more on a grand scale.
And it tends to help the winners of the year.
Exactly, yeah. So you're going to get a little bit more flows into the winners of the year in the fourth quarter. So sell in May, go away, come back in September. Volume, activity in the markets is the way to think about it.
So what you're saying is seasonality going into the end of the year, even though September tends to be a little choppy, pretty good time.
It is a good time.
Historically speaking.
Yes.
What question you got for me?
The question I have for you is about a lot of the headlines we've seen in the news about direct listings.
Yes.
So wanted to ask if you could explain what a direct listing is and kind of how is that different from the Wall Street norm?
Yeah, so it's a good question, Nick. So in regards to direct listings, it's a form of an initial public offering or an IPO that you might hear about in the news. Traditionally, Nick, in the past, as you know, a lot of companies would seek out an investment bank who would then pitch their stock to their clients to raise money. That's normally how an IPO goes. What some companies are doing is they've had their own angel or original investors that then actually take their shares and they'll just directly list it, bypass an investment bank, and they'll directly list on an exchange like the NYSE or the NASDAQ as an example, and they will then offer sometimes direct sales of their stock to, say, their customers. So this is not a recommendation to buy or sell this example, but one example is Robinhood, the online brokerage firm. They did a direct listing, they offered their customers to buy the shares, and they avoided utilizing an investment bank. So you might see that term more and more, but direct listing is when they avoid an investment bank for an IPO. All right. Join us next week, listeners, for another episode of Questions with Matt and Mark. Again, we're blessed to have Nick this week, and we will see you then.